Hey you, this is Christina Suter with Real Estate Breakthrough. I want to cover two concepts here. I've covered them before and I just want you to relook at them. The first one is your cap rate. Your cap rate is a pretty simple math equation, although at best it is usually an estimate. You take your net income before your mortgage payment, you divide it by your purchase price. That gives you the idea of what the cap rate is going to be on a building you're looking to purchase, or you can work with the actuals on a building and get your current active cap rate on a building that you own. The second concept I would like you to think about is a concept that was taught to me years ago by a veteran investor. It didn't make sense the first time I heard it, but it makes sense to me now, and hopefully it'll make sense to you. You do not want your interest rate to be higher than your cap rate on your building. Otherwise, your payments, your mortgage payments on your building will significantly start cutting into your cash flow and the positive performance on your building. Take a look at these two concepts. Let's hope they make you a better investor.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. Cap rate versus interest rate. Rule of thumb, very basic. You want your interest rate to be less than your cap rate, or the other way around. You want your cap rate to be greater than your interest rate. So what does that mean in flesh and blood? What that means is that if you're going to buy a building, let's call it a multifamily, with a 5% cap rate, that's an actual 5% cap rate, and the interest rate on the loan you're going to get is 4%, nice. That's the right direction. Because, let me explain this. To me, I think of it this way. I've got $1 million purchase price on a multi-unit. I'm going to put 30% down, $300,000 down. The rest I'm going to finance. Now, if I have a 5% cap rate and a 5% interest rate, 5% cap rate and a 5% interest rate, that means they're exactly the same number, right? So I buy $1 million building, I put 300,000 down, and I've got 700,000 financed. I have a 5% cap rate that pays my interest on my 700,000 at 5%. So literally all the money I'm making on that 700,000 bit of the building is going to pay my interest. The cap rate is your number that takes each building and makes it apples for apples, comparable against each other. So what is the cap rate? Because that is one of your guiding stars. One of your most important calculations is your cap rate. Now, cap rate is very, very simple. It's net income divided by purchase price. Net income divided by purchase price. That's very, very simple. Purchase price, we know what it is. But net income is sometimes confusing. So let's talk about that. Net income is your income after all expenses. Okay, cool. Net income is my income after all expenses. What are all expenses? You've got maintenance, like rehab on units that have become vacant. You've got ground keep, all of that type of stuff. You also have utilities that you need to pay for, and you have management fees. Those are all expenses. But don't forget, you also have property tax and insurance. So net income is your income after all expenses. All expenses includes maintenance, utilities, management fees, property tax, and insurance. In a commercial loan, 5 units and above, there is often a fixed time period and a variable time period. It's like a variable rate loan in the residential world, but there are very few 30-year fixed loans in the multifamily world. Usually they're fixed for 3 years, 7 years, 10 years, even though it's amortized across 30 years, because they're assuming an amortization or a payment across 30 years, but the rate, the interest rate, and therefore the payment only stays fixed for that number of years, 3 years, 5 years, 7 years, or 10 years. So I kind of don't like that. Like, wait a minute, hold on a second. You mean when it becomes variable, I could literally have my interest rate and my payment reset every year, and my payment that I have to pay out might go up, and I don't control that. I don't know about you guys, but that makes me nervous. Like, it literally makes me nervous. I'm like, I love 30-year fixed. I can understand what my payment's going to be, and every time the building is more valuable, I get to keep all of that. Every time I get higher rents, I get to keep all that. But if the interest in the economy, or the lending rate, the intrabank lending rate, has increased, my interest that I'm paying on my loan increases too. My suggestion for how the interest rate is meaningful to you in the refinancing world is, do not refinance your house unless you have at least a half a point to a point difference in interest rate. Then it is valuable to you, because things change anywhere from 5 to 10 years worth of ownership on a property. That's number one. Number two, interest rates when you're booking a loan. Oh my God, Christina, the interest rates are so low. I've got a 3.75 interest rate available to me right now, and they just changed it. They changed the interest rate to 4. Oh my gosh, I'm so disappointed that I've just lost that quarter of a point in my loan. Should I reshop my loan to see if I can get a better rate? Now, you guys can guess my answer. What's my answer going to be? No, a quarter of a point is not worth the price, the time, the effort of you reshopping your loan, especially since by the time you actually close that loan, your interest rate may have moved again. So that's 2. You want to see a difference, I would say, of at least a half a point to a whole point of interest rate difference before you think about reshopping a loan you've already pretty much are in the queue for. I'm paying the bank more and more of my return on my $300,000 that I have in. What if it gets even wider? What if my cap rate is 3% and my interest rate is 6% or 7%? 7% being the long-term standard for interest rates previous to 2000. It was 7% was considered the norm. So the fluctuation point that interest rates would fluctuate up and above, down, above and below that number. So you can see the rule of thumb makes sense. You want your cap rate to be higher than your interest rate. And the bigger that differential, either the greater return to you if it's in your favor, because you actually have an interest rate that's lower than your cap rate, woohoo, we like that. But if your interest rate is higher than your cap rate, we don't like that, because you're paying more to the bank, or you're paying part of your return on your 300,000 instead of it's just the 700,000 piece that is it. So you're paying more to the bank, and you might get to the point where you're paying more to the bank than the building is making pretty easily. Okay, guys, basic rule of thumb. I found it very powerful when I first discovered it. I even found it confusing the first time it was described to me, but hopefully I've laid it out for you in very basic understandings. You want your cap rate to be higher than your interest rate. This is Christina Suter on Real Estate Breakthrough Show. Make sure that you tune in either on Roku TV or YouTube, which we post twice a week, or whether it's on iHeartRadio, Spotify, or iTunes. You can listen to this podcast verbally, or check me out on ChristinaSuter.com if you want to book a session with me, or if you want to find out more about my mastermind course, and this is the type of stuff I teach in my mastermind course, ChristinaSuter.com.